Hello, and thank you again for checking out another video brought to you by myself, Dan Scharlach, and Innovative Wealth Partners. Today, I want to spend a little bit of time speaking upon the idea of should you or should you not use a financial advisor versus do it yourself. I have to be full disclosure and tell you that I am a financial advisor, so hence my opinion on the subject might be a little bit skewed towards the use of a financial advisor for at least certain attributes of what you're doing. Then I'll kind of wrap up by explaining why. However, there are times when you should not use a financial advisor to meet your objectives. So today, the first thing I want to start out with is kind of just going over some of the big hot buttons that you'll want to watch out for. The first is time. Time is by far and away the biggest thing that you will save by doing your financial services through an advisor or a professional. If you like the idea of research and enjoy enjoy reading, enjoy learning certain new aspects, enjoy learning new terms, then you should go out and do this stuff yourself. I can tell you my personal experience with the financial services industry is such that I am licensed to do certain products. Okay, pick on health insurance, for example. I haven't, nor will I, write a health insurance contract. I haven't written one since probably 2010, maybe 2000, I don't know when, to be honest with you. Many, many years, and I will not write them moving forward. That is not my forte. It's not my specialty. It's not something I'm good at. I don't study the market. That industry, that niche in and of itself, it probably isn't this way anymore, but a few years ago could have consumed an entire business. So for me to think that I can do that as well as all the other services that I provide to clients, in my opinion, was unrealistic. So I now refer that to other vendors or other professionals in the industry. That is a good example of a case where I myself, being in this industry, don't even sell or utilize all the products in the industry. However, you as a consumer could easily go out and research products on your own. Will take a lot of time, and you can implement those products on your own as well if you so desire. The terminology is something that I would just say will take a lot of time to learn if you're not already familiar with the terms. So there's a lot of jargon in financial services, and it's not jargon to me, but jargon to most consumers that is somewhat specialized technical words. They're not rocket science. They're not that hard if you want to take the time, though. Most of it is common sense if you think about it in its simplest terms. Your desire is going to be one of the other bigger factors to take into account. So if you have a desire to go out and buy one company's stock, you're probably better served to go buy that one company's stock on your own if that truly is your major desire and the main thing that you want to accomplish as an investor. You probably would be best served by doing that on your own. Not always, because you're not going to get advice by doing it on your own, but if you already know what you're going to do and you're not going to change regardless of what somebody says, then it's probably not a bad idea to consider doing that on your own. The costs are probably going to be lower on your own. And since you're not going to take the guidance anyways, that would probably be an acceptable way to make that transactional type decisions. I would be the first to tell you that there are going to be some cost differences in doing it on your own versus going to an advisor. So there are many products that do offer direct exposure to consumers. I say many, not really a lot, but there are a few. 529 plans come to mind as one where you're going to have an advisor version or a direct version. You are once again, you are going to save money by utilizing a direct 529 plan versus an advisor 529 plan. So that is a good case in point example of a scenario where you might want to consider doing it on your own. Like I said, a single stock might be another one. There are some insurance oriented contracts that sometimes do not have commissions built into them. They are very, very, very few and far between, but I have been told that they do exist. Usually you have to have a relationship with a fee-based advisor to get them, which negates the whole topic of conversation, but you get the idea. There are some ways to get contracts or products directly and avoid an advisor. In those instances, it's probably not a bad case for you to consider doing it on your own. The costs or the commissions that most people like myself actually get from many of the products that are implemented in the financial services world today are not nearly as high as you might think they are. So although it might be tempting to go direct, you might not actually be gaining that much other than the elimination of a human in your transactional process. If that's something that you like, then again, that may drive you to want to go direct. I would encourage you, if you don't like dealing with humans, to consider more direct relationships. So I would say from our perspective, those are a few of the biggest reasons that we would like to see people go direct versus with an advisor. However, there are many attributes that going to an advisor would offer that would make sense to consider going to an advisor. I want to end by giving you a couple of real life stories that are either warnings or true stories to be cognizant of. One is a leveraged ETF. This is not, these type of ideas are not alone or they're not singled out in the financial services world, but this is a specific example where if you're not careful using financial services products, you can get surprised. If you think about the idea of a leveraged ETF, it simply means owning an asset class tied to a certain underlying investment or underlying item, and that asset goes up or down based upon the movement of the underlying asset. A leveraged ETF simply means that we're adding leverage to the mix. The concept there is typically used to enhance or protect on certain maybe market moves that we might foresee as investors. They are primarily designed for single day or a very limited duration exposure. So they're designed to own for maybe a couple hours, a day max, maybe a couple days. I personally would not encourage anyone to own these, but if they do, I would make sure that they're aware that these need to be very short duration. If you look at the returns on this single asset class and you look at a long and a short ETF to a specific exposure, what you will find is that over time, both the long and the short exposures to these underlying asset classes go down in value. Okay, so you might ask, how does this happen? And it happens because simply these products are not designed to be held long term. These products are designed for a very specific function at a very specific time, and it's definitely a reason, in my opinion, if you're going to get complex or to want to really have a comprehensive plan or a comprehensive process, that you would deal with an advisor, because there are several products out there in the financial services world that just aren't geared to accomplish the things that maybe you think they are by reading the product highlights. If you read all the disclaimers and disclosures, that's another story. However, our experience is that many investors do not end up reading all those. So if you have any more questions, or if you have any questions, please feel free to reach out to us. We look forward to chatting with you soon.